Hello and welcome to the Insight is Capital podcast. I'm Pierre Daly, managing editor at advisoranalyst.com. My special guest is Ron Landry, head of Product and Canadian ETF Services at CIBC Mellon. If you're at all interested in the developments and trends shaping the Canadian ETF industry, stay tuned.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Ron, welcome. It's great to have you on the show.
Pierre, thanks for having me.
Yeah, so much to talk about. So, Ron, to kick things off, for the sake of those who don't know you, please tell us a little bit about the arc of your career, how and where you started in the financial industry or in the investment industry, what you do at CIBC Mellon, and what's got you busiest these days.
Sure. I surprisingly started in this industry more than 25 years ago at one of the largest no-load mutual fund companies, Altamira.
Yeah.
Started my career doing fund accounting, transitioned to corporate finance, compliance, was very fortunate. Somebody who was starting up a back office company asked me to come along and run the operations for them, and did that for a number of years before I took over running the company. And then, we were fortunate enough to have CIBC Mellon really interested in what we were doing, specifically around record keeping. And same time, we had just started supporting ETFs in that space. So
Right.
they came knocking, a really good opportunity for the overall organization to join a much larger organization. I joined CIBC Mellon back in 2009, dabbled a little bit in relationship management. We started winning some ETF business, so I put up my hand and said, here, I'm happy to run this part of the business for us. Did that for a number of years, and then in 2019, we had a opening. One of our senior executives had left that was leading product for the organization. So I put my hand up and said, I'm interested in doing that. And so, I've been running both product and our Canadian ETF business since 2019. So that, what's been keeping me busy the last 12 plus months is digital assets. All encompassing, probably since November of 2020. That's probably what I spend a significant amount of my time focused on. And right now, the last 12 months is really how do we support our clients even more than we are today in the digital asset space? And that's really around digital asset custody. And we're looking to figure out how we fulfill that gap in the marketplace.
Yeah, so that's quite interesting. By the sounds of it, you've been involved in bringing what has been the very first in the world, crypto ETFs to market. Is that correct?
We have, yeah.
That's something that
quite a few.
Yeah, that's something that the Americans haven't yet been able to do. That's so kudos to you. That's amazing.
Yeah, I have to hats off to our regulators. They have always looked to work within the confines of our regulations, to let our manufacturers come up with unique and innovative products. That obviously was clear when the first ETF launched here in Canada and over 32 years ago this March. So
that's right.
We're very fortunate. They put in in my mind, the right regulations to allow for this market to grow.
Never, ever let it be said that Canadians aren't innovative. That's just
right.
That's just one of a slew of, world-changing innovations that Canadians have spearheaded. So, Ron, markets have gotten off to a rough start in 2022. We've just been through some pretty tumultuous and exciting times during the last couple of years, and what were, until the end of 2021, pretty hot investment markets. So from your unique position at the center of the Canadian ETF industry. What are you most excited about these days?
Yeah, look, I think the industry continues to adapt to investors' needs, trends, by developing really low cost, transparent products, creating products that allow them to access difficult to access securities or investment strategies, and that's been at the forefront here in Canada, even before digital assets, whether it
Yep.
was accessing commodities, gold, silver, those type of products have been really the forefront of ETFs and giving investors the opportunity to invest in those types of asset classes that if they tried to do it on their own would be very hard and complicated to do. So, I think that's definitely something that I'm really excited about, that just the continuing innovations of the products that have come to the market. Obviously, the main driver at the forefront for investors is, choice, simplicity, diversification, transparency, cost. And then the ETF products are expanding into more active, more thematic, lately responsible investing strategies. It's been the talk probably for, leading up to the pandemic, probably 2 or 3 years ahead of that. But with the pandemic has really shifted investors' mindset to the impact that the environment's having, and, even social items as well, right? So, it's just been really interesting to see that dynamic shift. And then, I think ETFs are now being used by both Canadian investors and their advisors as long-term portfolio holdings, a buy and hold, which,
Right.
historically, I think a lot of people looked at ETFs as quick in and out investing, because it's on an exchange. But I think, really ETFs have just become another investment tool that an investor can use, just like mutual funds, to make the right investment, whether it's part of their core portfolio or part of their satellite portfolio. It's really there to help them grow their overall investments. And, I think that demand for ETFs will continue to grow in the next 2 or 3 years. Like I think it's been wonderful growth that we've seen, and I think it's just going to continue. Asset managers, traditional asset managers that historically just launched mutual funds, are really jumping into the ETF space, whether that's launching their family of ETFs or, if they have a really strong mutual fund product that they think would be of interest to ETF investors, they're adding that ETF share class. So we're really excited. We think that, the theory or the thought that historically has been is, they're just an ETF provider, is gone out the door. And I think we're going to see more traditional asset managers come into this space and launch products, which I'm really excited about as well.
My question to you was going to be that, what have been some of the biggest trends shaping or driving the ETF space? And I think you just answered that, which is that what once was considered, by many investors to be ETFs that, were tradable, that you could use to get in and out of markets easily, has shifted to products that are more structured, that provide longer term solutions that investors can get into and own for an extended period of time or for the long term.
Yeah. And, I think as investors become more knowledgeable of ETFs and how they work, the shifting, advisors are shifting, investors are shifting to ETFs because they're just as successful as mutual funds at time. And, the low cost nature, and they seem to be doing a lot of innovative stuff. And digital assets is a perfect example, right? That was probably the hottest topic in 2021, with both the first Bitcoin and Ether ETF launching. The adoption has been wonderful, and we expect it to continue to grow.
Are there any other segments or kinds of ETFs that you're seeing accelerating or growing rapidly?
I would say the ESG, or responsible investing, happens to be a very interesting trend. A lot more of the ETF providers, asset managers are launching a suite of responsible investing products. So it's not just one-offs. You're seeing them, launch, 5, 10 at a time to really address the demand that's existing in the market for these type of products. It'd definitely be interesting with the volatility we've seen in the market. I think this is going to be a really good opportunity for these type of products to show that they're as robust and perform as well, or if not better, than traditional ETFs when it comes to the underlying investments and actually focusing on environmental, social, and governance, especially, with the pandemic, the war that's going on in the Ukraine. These are all areas that I think should be interesting to see how it plays out. 2021 was a really superb year for the ETF industry. But, on top of that, we saw a real strong momentum in the ESG space, or the responsible investing space. At the end of 2021, there's 8.2 billion in responsible investing ETFs, though it only represents 2.4% of the total ETF assets. The flows that came in last year was quite strong. It was 4.2 billion, or 7.2% of the total net sales, which we're really excited about. Like it's starting to really pick up some really strong flows, and we expect that to continue into 22.
Ron, how has the industry been pivoting in the face of possible changes in market regime with rising rates, the inflation threat? What are you seeing from your position?
So, I think Canadians are now looking for protection from inflation. February, I think, was 5.7% was inflation. So, they're obviously looking at products such as, broad commodities, gold, floating rate securities, tips, short duration, fixed income. With the uncertainty in the global environment, we're seeing more home bias investing, or North American investing. Right. In some ways, I'm surprised by the numbers, but of the 8.8 billion in inflows so far this year, 65% of that flow has gone into Canadian and U.S. equities, which
wow, interesting.
I was surprised by. But the markets are still strong, and Canadians like North America. It's a market they know, and equities are doing well, and so they continue to buy them. So that's where we've seen a lot of the flow going so far. At the same time, where people are looking for yield. Obviously, Canadian investors are getting older, getting closer to retirement. If not in retirement, interest rates are still low. So even though we saw a bump in interest rates in February by the Bank of Canada, we and there may be other increases, interest rates are still at historical lows. So they need to find yield, whether that's investing in global fixed income, dividend paying ETFs. It's all around trying to find a steady stream of income that's going to help investors and support their retirement.
What are some of the newest or most interesting ETF solutions you're seeing come to market?
There was a suite of new target dated ETFs that came out from a new ETF provider, which should be interesting. We've seen that historically in mutual funds, where they have target date mutual funds. This is the first time we've seen it in an ETF. It'll be interesting how it fares against the one ticket portfolio. A lot of the larger ETF providers have been coming out with whether it's growth or balanced or conservative or fixed income one ticket type portfolios. But this is the first we've seen come to market that's actually target dated. So it'll be interesting. Maybe not much different than when RBC originally launched their fixed income target dated fixed income products, but this is interesting. Wish them all the best in success. If it does well, I think we'll see other other providers come out with similar products.
Has there been any change in the flows, in terms, or has there been any change in the amount of attention given to certain areas, given the way the market has gone so far this year in 2022?
Yeah, it's according to the National Bank financials monthly ETF flow, like I said, we're 8.8 billion in flows up until the end of February, which is a billion lower than last year at the same time. Flows are really, like I said, focused on equities. Makes up 86% of the total flows is going into equity-based ETFs. Other areas that we're seeing flows are multi-asset, fixed income, and the fixed income are really are really just cash alternatives or inverse leveraged. So HISAs are still really popular, or high interest saving accounts. So they're definitely seeing some flows. Commodities so far this year, the only asset group that's actually negative flows, which, considering the market and what's going on, I thought I would have seen a little bit more going into commodities. Obviously with oil hitting some interesting numbers, the move away from the American dollar into gold, there could be some interesting flows that go into commodities. So far, equities are still knocking it out of the park. It's where most of the assets go year over year, and seem to still attract a lot of the assets today. Which is interesting. That even though we have strong flows and product growth, so we've seen, I think 49 new ETFs come into the market this year, or 43 versus 29 last year. Unfortunately, overall assets are down from December's high. So, we were at 348.6 billion at the end of December, and at the end of February, we're down to 327, which we haven't seen assets that low in the ETF space since October of last year. So you can see how much the market has really impacted the overall growth of the ETF space.
3 years ago, when we spoke last, the hot thing that was happening in the market was the alternative space. And now that a lot of some of the newest entrants in the alternative space, when the deregulation came for liquid alts, now some of these new ETFs have had 3-year track records. Are you seeing any uptick in interest in alternatives as a result of having these 3-year numbers? How is the alternative space growing or gathering steam?
I still think it's slower than anybody anticipated. I think we're at the end of November, we were about 20 billion in total assets, which is significantly lower than I think the market really had thought they would be going. Look, I think alternatives is all going to boil down, or liquid alts is really going to boil down to the type of liquid alt it is. I think this market that we're in right now is really going to benefit investors who have picked the right product to safeguard against market volatility. So if there's a liquid alternative fund out there and that meets that need, and there are some examples out there. Horizons has a number of bull and bear type leverage products that fall under the alternative banner. I think anybody who was betting against the market going, or betting that the market was going to go down, will have done well in their inverse products. As somebody thought that commodities were going to go through the roof, and they were bullish on that and picked their commodity products that are leveraged upwards, they're going to do well as well. So, at the same time, it's really picking the right product under that alternatives banner that meets an investor's need, whether it's from seeking additional alpha or really just protecting against market downturn. You look at the alternative space, equities as well, liquid alts, the equity type products are where you're seeing the flows, which is interesting. We thought multi-strategy would really pick up from that perspective, but I think unfortunately the way the regulations are written, it makes it a little harder for multi-strategies to do well from that perspective, or at least to structure a product that's really multi-strategy. I think the regulators have done a really good job of granting exemptions where they need to really promote the adoption of liquid alternatives. Like if you have a really good story on why you need to be outside the parameters of the regulations, so far the regulators have been very open to granting those exemptions, which we're always happy to see.
What would you say have been among, or what are among the most progressive or structured, active, or innovative ETF products that you see coming this year?
A lot of the demand we're seeing, at least of discussions we're having with our clients today, is going beyond Bitcoin and Ether. So, additional coins they're looking to bring to market, digital assets are the areas that they're really looking at, or at least discussions that we're having quite a bit of dialogue on, which we're pleased to have. We just actually got our internal approvals to add additional coins to our suite of that we can support from an administration standpoint in this space.
Right.
And then really, we now have clients talking to us again about, bullion. So I think the market, the way it's going now, we have, there's obviously bullion ETFs out there, but we now have clients that are like, hey, we've discounted it in the past, but maybe we'll relook at that. So they're looking at how they can come to market with, maybe an innovative way to offer a bullion ETF. So, those are the things that we're seeing, like other than responsible investing, ESG type products. Those are the things that we're probably having the most conversations about at this point. Which, we're always happy to lend a ear and try to find ways to support our clients. Who knows what the next innovative type product will be, but I'm quite sure our clients will be asking us whether we can support them in doing it, whatever it is.
Ron, what do you see happening in the way of promising or progressive regulation or regulatory change in the pipeline that could affect things one way or another?
Yeah, I'd say the biggest talking point today in at least our industry is T+1. So, both Canada and the US are looking to work towards T+1 in 2024. We have industry groups that are working, they've been stood up probably late last year, and just driving towards getting to T+1. The Canadian ETF Association is involved with the CCMA in making sure that there is no gaps in what's going to be introduced. It definitely is, the goal is really to reduce counterparty risk, reduce margin requirements, decrease clearing capital requirements, and then just increase global settlement harmonization. So, I think this is all the drive towards someday T+0, same day settlement. It does really change how processes need to occur. So it's definitely a heavy lift for the market to make sure all the players, all the stakeholders can move towards a T+1 environment. We're very fortunate as a custodian. We can support it. It's the rest of the market that needs to be able to shift to that, right? And that's people trading, counterparties. What does that mean? Can they do it? A lot of things have been overnight batches. As long as we match by T+1 at noon, everybody's good. That doesn't work if we're moving to T+1, right? So how do we move up the timelines? What do we do when there's things break, and just making sure that the market is still robust and supportive of the overall industry. And then, the other thing that has been a hot topic, at least for ETFs in the last few years is, allocation to redeemers, the cap gains to redeemers discussion. Obviously in 2019, in the budget that was released, they basically got rid of the ability to appoint cap gains to redeemers the way that it has historically been done. The finance and the federal government has been very supportive in allowing us to defer the introduction of the ATR for ETFs. We've had ongoing discussions with them all the way up until, now. They obviously, we had some really good discussions with them. We proposed a number of scenarios. They finally came back and said, thank you for all the insight, the education. We're going to come back to you with what we think is an appropriate approach. We saw what they thought their appropriate approach was in their release in February. We think it's fair in the way that they've approached the scenario based on what they told us they were trying to accomplish. So transparent ways for them to actually test whether allocation of redeemers was actually working. They also did some changes to the cap gain refund mechanism as well that really helps the ETF industry. So, both between the Canadian ETF Association and IFIC, we're actually drafting our response back to finance. We are looking to ask them to reconsider once again some of the submissions that we put in. But that said, we believe this is a fair outcome that will benefit the ETFs here in Canada versus the initial rule that they had proposed back in 2019 that would have disadvantaged the ETF industry as a whole. So, we appreciate finance working with us, listening to us, having, I would say a multi-year discussion on what we thought was fair. And, they took what we had to say and came up with their proposed rules. And we think it's fair. Hopefully it ends up being fair to as many investors as possible. But we think it was the right approach.
That's very interesting. It's really interesting to see how technology is making it possible to do away with the sort of arcane, settlement procedures of the past, and how that should improve overall liquidity in the market. And also, I think investors are sick and tired of the unfairness on tax rules with regards to whether you're a long-term holder or an intermediate or holder or trader. That the past treatment or past attribution of capital gains wasn't being done on the basis of how long an individual held a fund, and what they paid and what they exited, and it wasn't necessarily being attributed to them specifically. But once again, technology and data are making it possible to be able to single out traders from long-term investors, so that the long-term investors aren't being saddled with someone else's tax bill at the end of the year. It's very, very interesting, Ron. Thank you so much for your insight and your incredibly valuable time. It's great to have you.
Thanks, Pierre. It was great to be able to talk with you again, and look forward to doing it again with you soon. Hopefully next time in person.
Yes, and we won't wait so long.